Hello and welcome to our presentation on human resource accounting. A brief introduction on different models. According to American Accounting Association, human resource accounting has been defined as a process of identifying and measuring data about human resources and communicating this information to the interested party. So in principle, it is to show the human resources on the balance sheet. So the question that HRA will try to address is how to bring the human resource onto the balance sheet. There are different models for that. If we say that human resource is an asset, so first we have to check whether it fulfills the definition of asset. Asset is anything which has the ability to generate future cash flows. Since human resources also have the ability to generate future cash flows, so we can assume that human resource can be treated as an asset. If it has to be treated as an asset, we have to find out what will be the value of it. So the value, just like any other models of asset accounting, can be cost model or the present value model, which is also called discounted cash flow model. In case of cost models, all we try to do is take the historical or acquisition cost of acquiring a human resource for recruitment and training and amortize that cost over a period. That is the historical cost. Whereas in case of replacement cost, we try to find out, instead of money spent, but we would like to understand how much will be required to replace an existing human resource, either on an individual replacement cost basis or on a positional replacement base. But nonetheless, it again sticks to the cost only. In case of opportunity cost model, a single human resource, if it is required by different responsibility center, the value that each center is trying to put on this resource, the highest of that will be taken as the value of the human resource. In case of opportunity cost model, we use the concept of the benefit sacrificed. The opportunity cost is taken as the value that a department or a function or a responsibility center would like to pay to get that resource. So these cost models are not very popular, so they have not been used extensively in valuing the human resources. One of the commonly unpopular models of showing the human resource on the balance sheet is a present value model, which is also called discounted cash flow model. The present value model tries to measure the economic value rather than simply record the investment at an historical or replacement cost. The model seeks to measure the value of the human resource on the basis of the present value of the services to be generated by the employee of an organization. And we assume that the value of the services generated is reflected by the salaries that we are ready to pay to that person. So the present value model discounts the future salaries and employee related expenses at a certain rate of discount. Normally the discount rate is the cost of capital. Now let us take an example to understand this model. Suppose in an organization, in a very simplified manner, I'll say that there are 4 different classes of employees, and one group of employees are going to get 50,000 without any change for next 25 years. May not be very realistic, but for the sake of discussion, let us assume that 50,000 will be given to this group for next 25 years. Other group, of which consists of 100 employees, they're going to get 20,000 for first 10 years, then 30,000 for next 5 years, and in the last last 10 years they'll get about, last 5 years they get 60,000. The third category also, there will be 30,000 up to the 10 years and 36,000 for next 5 years. And the fourth category has 5 persons which are going to get 200,000, okay, 200,000 for next 5 years. So therefore, though with an understanding that this may not be the reality because the salaries will keep on changing, let us assume that this structure is there, and let us find out the value of these 100, 25, 20 and 20, and so total 150 employees. 150 employees. The value of this 120 employees or 150 employees is a present value of each individual class discounted at a certain rate. Let us assume the rate to be the WACC, or the cost of capital, is 18%. So the present value of the first group of people, that is A category people, which are 25 in number, okay, and so the present value of per person has been determined by using the NPV factor. In the same manner, we'll find the present value of the second category people by using the same rate. Second category people of workers or employees, okay, so we get the present value of this group per person. We'll find in the same manner the net present value of the C category people, with the same rate of discount, and the discounted value per person is 156,332. Then let us find the present value with the same rate of discount factor for the D category is, okay, into 25, 100, 20 numbers in for C and 5. So the total value for each category is equal to, okay, so the value of all the human resources in this example comes to 25 million. 25 million is the value of human resource by using the discounted cash flows. So for each category we found the present value for a particular, assuming a particular cash flows, assuming that the money paid to the employee reflects the benefits that we are going to get, and discount that at the cost of capital and multiply with the number of people in that category, gives us the value of the human resource. Now normally this is called a non-GAAP number because the generally accepted accounting principle does not require a company to show the human resources on the annual report. However, many companies have started showing that value. So this number may not appear on the balance sheet but is generally shown as an additional information, as a voluntary disclosure information. But you can see that this is subject to, this depends on, the value depends on the cash flows. If this changes, this value will change, and more important is the discount rate also if changes. If the 18%, if the discount rate is 18%, this is 25 million. If the discount rate is 12%, if the discount rate is 12%, it is 37 million. If the discount rate is 20%, the value comes down. So the human resource value to a large extent depends on the assumptions regarding the future cash flows and the cost of capital, which will be used as a discount rate. Thank you very much.